Hello, in this video, I'll teach you about the best Bollinger Band day trading strategy used in trading stocks, forex and cryptocurrency. So stick around till the end of the video to understand. Just to define, the Bollinger Bands are a technical analysis tool developed by John Bollinger for generating oversold or overbought signals in the market. The distance of the band is based on standard deviation and they adjust to volatility swings in the underlying price. The Bollinger Bands use two parameters, which are period and standard deviations. The default values are 20 for period and 2 for standard deviations, although you may customize the combinations according to your preference or trading strategy. To read and interpret the Bollinger Bands, when the bands narrow during a period of low volatility, it raises the likelihood of a sharp price move in either direction, and this may begin a trending move. Be careful to watch out for a false move in the opposite direction, which then reverses before the proper trend begins. When the bands separate by an unusual large amount, this increases volatility and signifies that any existing trend may be ending. Prices have a tendency to bounce within the band's envelope, touching one band, then moving to the other band. You can use these swings of low and high to help you set potential profit targets. For example, if a price bounces off the lower band and then crosses above the moving average, the upper band then becomes your next profit target. Price can exceed a band envelope for longer periods during strong downtrend or uptrend markets. A strong trend continuation can be expected when the price moves out of the bands. However, if prices move immediately back inside the band, then this suggests a possibility of a fake breakout. Bollinger Bands can be used to see how strongly an asset is gaining and when it's likely to reverse or lose momentum. If an upswing is strong enough, it will consistently approach the upper band. When an uptrend reaches the top band, it means the stock is moving higher and traders can take advantage of the opportunity to buy. Price pullbacks within uptrends, staying above the middle band and moving back to the top band, indicating a lot of strength. To make a trade, you can take a long position, putting your stop loss below the recent swing higher-low area and target a 1 to 2 risk-to-reward ratio. In general, a price in an uptrend should not hit the lower band, and if it does, it is an indication that a stock is losing strength or is about to reverse. As a technical trader, aim to profit from the strong uptrends before a reversal occurs. Once a stock fails to reach a new high, take your profit or exit the market at this point to avoid incurring losses from a reverse trend. Bollinger Bands can be used to determine how far an asset is falling and when it might be turning to the upside. The price will run along the lower range in a strong downtrend, indicating that selling activity is still active. If on the other hand, the price fails to contact or move along the lower band, this shows that the downtrend may be losing momentum. There is a lot of downtrend strength when there are price pullbacks and price stays below the middle band and then moves back to the lower band. To take a trade, you can take a short position, putting your stop loss on the recent swing lower high area and target a 1 to 2 risk-to-reward ratio. Prices should not break above the upper band in a downtrend, as this will imply that the trend is reversing or slowing. Many traders avoid trading during downtrends other than looking for an opportunity to buy when the trend begins to change. The downtrend can last for short or long durations, either minutes, hours, weeks, days, months, or even years. Bollinger Bands use W patterns to identify double bottoms when the second low is lower than the first low but holds above the lower band. This occurs when a reaction low forms close to or below the lower band. The price then pullbacks towards the middle band or higher and creates a new swing low that holds the lower band. When the price moves above the high of the first pullback, the double bottom is in place, and this indicates that the price will likely to rise to a new high. Like on the chart below, we can take our trade after the break of the neckline, putting our stop loss below this swing low area and target a 1 to 2 risk-to-reward ratio. The double top occurs when there is a reaction that moves close to or above the upper band. The price then pulls back towards the middle band or lower and creates a new swing high point, but does not close above the upper band. If the price then moves below the low of the prior pullback, the double top is in place and this suggests the price will likely to go lower. Like on the chart below, You can take a short position after the break of the neckline, putting your stop just on the swing lower high area and target a 1:2 risk-to-reward ratio. Another strategy to consider when trading with the Bollinger Bands is the Bollinger Band breakout or squeeze strategy. A squeeze happens when the price has been moving aggressively, then starts moving sideways in a tight consolidation area. A trader can visually recognize when the price of an asset is consolidating because the upper and lower bands get closer together. This indicates the volatility of the asset has reduced. After a period of consolidation, the price often makes a larger move in either direction, ideally on high volume. Breakouts are not hard to identify, but the challenge too many traders face is that they mostly fail to progress or end up being a trap. So to increase our winning probability, we'll add another indicator, which is the Average Directional Index, also called ADX. This indicator will help us to know if the breakouts are valid by showing us when the ADX indicator is strong enough for price to trend after the breakout. You can watch my video on the ADX indicator through the link in the description below to understand more about it. When ADX rises from below 25 to above 25, price is strong enough to continue in the direction of the breakout. Expanding volume on a breakout is a sign that traders are voting with their money that the price will continue to move in a breakout direction. When the price breaks through the upper or lower band, the trader buys or sells the asset respectively. A stop loss order is usually placed outside the consolidation of the opposite side of the breakout. To take an example, on the chart below, we can see the market was consolidating in this area. Suddenly, a breakout occurred at the same time the ADX indicator was above 25, confirming the breakout will continue with the trend. We take short position, targeting a 1:2 risk-to-reward ratio and put our stop loss outside this consolidation area. Watch my next video on the easy 1-minute scalping strategy that top traders use to get more profitable in your trading journey. If this video has been helpful, remember to like, share and subscribe to the channel for more feature content like this. Till next time, see you.